There's a saying that riches are made in recessions, and it doesn't take much to see that we're already moving towards that point. Even though this sounds bad, recessions happen all the time, and if you know what you're doing, you can use them to your advantage. So, before we talk about the best upcoming opportunities, you first need to quickly understand what you're going to be up against. To start, we need to talk about a recession. Generally, recessions are accompanied by a significant rise in unemployment, a drop in wages, a loss in consumer confidence, and a decline in values, across everything from stocks, food, energy, and services, with sometimes long-lasting effects throughout the entire world. But second, along with the recession, usually comes a decline in earnings. Every quarter companies report the revenue and give guidance on their future outlook. But lately they've been cutting forecast, bracing for slow or even negative growth, inciting recession risks at the highest pace in 10 years. This leads us to third, layoffs. When consumers earn less, they spend less. And when companies see less demand, they begin to scale back on their expenses, with usually employees being the first to get let go. In fact, just a quick Google search for mass layoffs shows you dozens upon dozens of companies who are all trimming their workforce. And as Bank of America explains, the U.S. economy will soon start losing 175,000 jobs per month. So in terms of what this means for you and your investments, as well as how you could use this information to make you money, let's start here with number 1, stocks. As of now, all 3 major indexes are down between 20 and 30%, with analysts like JP Morgan, who believe that we have another 20% to go from current levels. However, if we take a look throughout history since 1946, the average bear market drop has been close to 30%, with the most severe being in 2009, when the S&P 500 fell 57% from its peak. Now, once you combine the average with the recession, bar markets tend to do even worse, with an average drop of 34.8%. For all of that reason, the exact bottom usually happens when investors give up. That's when the rebound starts, and things start to get better. I'll tell you how much you can make from this in a moment, but first, we need to talk about number 2, real estate. Every area is different, and some areas may continue to do well. Housing declines on a national level are actually incredibly rare. In fact, as you can see throughout the last 60 years, there have only been a few times where prices meaningfully fell more than 10%. But now the general Wall Street consensus is the national housing prices are going to decline 7%, with a worst case decline of 10% to 15%, should interest rates continue to increase. Of course, every market is going to be different, and according to Moody's Analytics, the most vulnerable markets could see upwards of a 25% decline from the peak, including parts of Florida, Arizona, Idaho, and Southern California, with the decline lasting another 12 to 18 months before bottoming out. Now, in the big picture, it's probably not going to make that big of a difference for anybody with a fixed-rate mortgage who intends to stay in their property for another 5 to 10 years. But for anyone looking to invest or buy a house, we may begin to see some deals starting to come on the market, which we'll cover shortly because we have to also talk about third, cash. Clearly, up until now, there's been mindset that cash is wasting away to inflation. But when every other asset is falling in price, sometimes cash could be the safest place to store your wealth. And, that's significant. When someone like the billionaire Ray Dalio admits that cash is no longer trash, a lot of people forget that as recently as 2018, cash was the best performing asset. If you had put your money in a high-yield savings account, you would have far outpaced the market. Cash is now such an important part of the portfolio that even fund managers are holding on to the most cash they have since 2001. Citigroup said that cash is the only asset that investors could use as a recession hatch. But what could you do about this? So, to see why this next decline might be a once-in-a-generation chance, just think about this. Everything gets cheaper. From my point of view, even though some people might think this is a bad time to buy, everything is falling 30%. An extremely rich person would see this as a chance to get those same businesses for 30% less. Warren Buffett had the perfect comparison for this. When hamburger prices go down, we sing. When hamburger prices go up, we weep. For most people, it's the same with everything they buy, except stocks. When stocks go down, you can get more for your money, so people don't like them anymore. First, Change your belief, because a falling market could work to your advantage once there's less competition. The fact is, when times are difficult, companies scale back, they fold, they conserve cash, and they play it safe. But this opens the door for smaller, more aggressive companies to stand out and take their place. For example, one study across 16,000 companies found that those who continue to advertise increased their value and got more bang for their buck. With positive growth years after the recession ended, the third, there's way more opportunity in a way. A recession is the market's method of weeding out the weak. A wise investor made a fantastic comparison a few months ago, that the peak of the market cycle is exactly like a forest. This means that only the largest, most established trees or companies get access to all the resources, or in this case, sunlight. Everything at the bottom has a difficult time being able to compete, and it's hard to grow. But just like natural forest fires, our economy has a way of repeatedly clearing out and bankrupting the companies that are no longer able to sustain themselves, giving opportunities for newer, smaller businesses to continue to develop. The fourth, after every bear market comes a bull market, as Yahoo Finance points out. Historically, the S&P 500 has fallen an average of 29% around recession, with a median drop of 24%. But once stocks have found their low, their average return the following year is 40%. And within 2 years, the market has increased an average of 58%. This means that investing on the way down is much more profitable than pulling out of the market and waiting. And long-term, the market has always recovered in every single example so far, throughout history. And finally, on the fifth, you have to act before anyone else knows about it. I know it sounds easy to think, oh, perfect, I'll just invest during a recession. But the truth is that recessions aren't officially recognized until much later. For example, the Great Recession started in December 2007 but wasn't officially recognized until December 2008, just a few months before it ended. The previous recession started in March 2001, but wasn't called a recession until November of that year. This pattern continues, with a delay of about 6 to 12 months before we know we are in a confirmed recession. This means you keep an eye on the market, cut back on spending you don't need to, and live on less, while continuing to put as much money back into the market as you can. You should also have a plan for what you would do if your income dropped 20 to 50%, how you would make up the difference, and if there are steps you could take ahead of time to keep that from happening. Number 2, hold on to some cash. Now, I'm a firm believer that even though, statistically, your money is best off invested as soon as possible, there is something to be said about the peace of mind of having cash on the sidelines, just in case of something to fall back on. For me, cash makes up anywhere between 15 and 20% of my portfolio, depending on the time of year. But generally, this has given me so many opportunities to jump on good deals when I find them, and it lets me sleep at night, knowing that, no matter what happens, I have something to fall back on. Number 3, protect your career. This, at the end of the day, is going to be your best hedge against whatever happens. Because financially, your worst-case scenario is not the market going down, but instead, it's the market going down at the same time, that you lose your job and have to sell off your investments at the bottom before they have time to recover. So, now is the best time to improve yourself, learn new skills, and double down on whatever you're currently doing. And after that, number 4, invest long-term. The best course of action when it comes to investing is to simply carry on as usual and pretend like nothing's happening. It's shown that dollar cost averaging, or the practice of buying into the markets on a regular basis, is the most profitable strategy. So stay in the market and continue buying in. And 5, diversify your investments. Now, if you can't personally handle a 20% drop without panicking, it's probably a sign that you're investing too aggressively. For instance, if you're completely in US tech stocks, then it's probably a good idea to add large caps and international stocks to the mix too. Or potentially look into investing in real estate or buying rights for rents. Tend to be a little bit more stable. A diversified portfolio is less likely to fall apart if 1 or 2 investments fail. This is also a great time to learn as much as you can, get a side job, and double down on your work, because whatever you do today will pay off many times over when the market recovers. It won't be easy, but those who stick it out will be rewarded. Thanks for watching, and subscribe for more videos.